All right, now one of those voices saying an increase in the discount rate could be coming sooner rather than later is Lawrence Meyer. He is vice chairman and co-founder of Macroeconomic Advisors. He's also president of Meyer's Monetary Policy Insight and a former Federal Reserve governor. He joins us now from our Washington, D.C. bureau. Larry, great to have you back here on Bloomberg and here on Street Smart. So let's talk about what might we see. Let's break it down. There's obviously several instruments the Fed has to play with. The discount rate. Are you anticipating an increase anytime soon?
Yes, very soon. And I think Josh got it exactly right. This has absolutely nothing to do with monetary policy. The markets respond to it as if it does. So they must think the chairman is lying or they didn't read the testimony. So that doesn't guarantee that we're going to get another increase in the discount rate soon. But the importance, if you're going to raise it further before you raise the policy rate, you have to do it soon. So the markets have less chance of connecting it to monetary policy, and they're going to connect it more to why the Fed is doing it, to liquidity policy, to normalizing its various liquidity arrangements, because the crisis is over.
Right. So, Larry, in your view, I mean, we need to do this already. It's time.
Well, I think the issue is to the extent that you want to get it done, you want to get it done soon. There's nothing magical about 100 basis points, but I would presume that's where they're going. That is the spread that they consider normal. And if you want to get it back to normal, you either have to wait into 2011 or you have to do it soon.
Right. What about then the Fed's policy rate? I've had guests on here who say we don't see the Fed raising interest rates until about a year from now. What's your view?
Mid-2011.
Mid-2011
is where we've been for quite a long time.
So the Fed still has a lot of leeway here. So you're not worried at all about inflation here?
If I'm worried about inflation, it's that it's going to be too low for quite a long time. And the chances of it being systematically above 2% are probably no greater than the possibility we'll have deflation.
What are the risks, then, that come with that? Spell that out for us, if you would.
Well, it's all about the strength of the economy, the amount of slack in markets. We have a situation now where the unemployment rate is high, 9.7, likely to linger very high for a very long time. It's the most slack we've ever had in an expansion in the post-war period. Slack lowers inflation, and it's going to be there for a long time. Inflation should be falling. It's now, remember, the core PCE, which is the favorite measure, has increased 1% over the last 6 months, about 0.5% over the last 3 months. So inflation is low and it's falling. Okay, so we expect inflation to be 1% this year, slightly below 1% next year. The data is really, really moving in that direction.
Well, let me ask you, because as you say, with inflation so low and the Fed yet still keeping rates so low, and you anticipate that the Fed won't raise rates until maybe, sometime next year, midtime next year. I mean, does that make sense? I mean, doesn't the Fed have room to raise rates here, considering how low inflation really is?
No, I mean, precisely because inflation is too low, that's why they don't want to raise rates. They want inflation to be higher. And what you have to think about is this. Let's go to the end of this year and see what people like us and most forecasters are expecting. An unemployment rate above 9%, let's say 9.25%. Inflation very low, in our case, 1%. So you want the Fed to begin tightening at that point. I think that's almost inconceivable.
All right, we're going to have to leave it on that note. Larry, great to get some time with you. Thank you so much.